Hi, everyone. We are going to take a look at Chapter 9, which is now expanding on the analysis we've been doing so far using net present value and equivalent annual costs. So some of these concepts we were looking at in Chapter 8 will be carrying forward with us now into Chapter 9. So this chapter focuses on risk analysis, real options, and their roles in capital budgeting. If I can get my. So we're going to look at ways companies use net present value to make ultimately decisions. So one item is called the decision tree. Another is applying scenario and sensitivity analysis. We're going to look at what we call break-even analysis and just talk about this thing called the Monte Carlo simulation, and then apply real options in capital budgeting. So that's our breakdown. So here's our first item, the decision tree. So as you can see, as it states there, and as you saw in your book, these are graphical pictures of our alternatives available in each period and the consequence of our choices. So looking at the big picture in a graph, in a picture, right? Not to sound redundant, but will help us make the best choice and take the best course of action. So here's an example, a very simple example of a decision tree. And maybe some of you are going, I should have created that decision tree back in August. But taking a look at, should you study finance or do not study finance? Well, if you want to get your MBA, right, you have to study this course. But the squares represent decisions that need to be made. So when we are looking at this picture, we see this square and right in the very beginning that says, well, if I study finance, what are the possible outcomes? I could get an A, B, or C. So our circles represent information, for example, a test score. So when you study finance and you get your test score and you really study finance, you can get an A, B, or C. But if you choose not to study, you can receive a D or an F. So the lines leading away from the squares represent our alternatives. Okay, so that's just a very simple depiction of a decision tree. Well, let's look at an example. Stewart Pharmaceuticals Corporation is considering investing in the development of a drug that cures the common cold. Oh, please, right? A corporate planning group, including reps from production, marketing, and engineering, has recommended that the firm go forward with the test and the development phase. So here's what's happening. The preliminary phase will last 1 year and cost $1 billion. Furthermore, the group believes that there is a 60% chance that the test will prove successful. If the initial tests are successful, pharmaceuticals can go ahead with full-scale production, and the investment phase, so now 1 year later, the investment will cost $1.6 billion, and production will occur over the following 4 years. So here's our initial investment, cash flow coming out. And here's the information that will occur related to this pharmaceutical production over the next 4 years. So years 2, 3, 4, and 5. Now, one second, I want to talk about this thing called variable cost and fixed cost. So if you've never really had an accounting class before, especially a managerial accounting course, these may be foreign to you. A variable cost is a cost that changes as the number of items or the amount of production changes. So if production goes up, variable costs will directly change and go up. If production goes down, it will variably change with how production changes. So variable costs are dependent on the production. Fixed costs are constant. Whether you make anything, have any production or not, you have these kind of costs, like rent on the facility, the salary of the supervisor, okay? They don't change with production, but variable costs will. So maybe electricity is an example of a variable cost. Materials used in production, these are all variable costs. So you understand that difference. So they expect when they have revenues of say 7,000, should be 7 billion, variable costs will be 3,000, fixed costs will be 1,800, and depreciation on that initial investment will be 400. So these are given. So we're not calculating them. What we are calculating now is cash flow. So given this information for years 2 through 5, the pre-tax profit is $1,800, 7,000 minus 3 minus 1,800 minus 4. Tax on that profit will be $378. So net profit is $1,422. If we add back the depreciation to our net profit, remember that's one way of getting operating cash flow. So this company's operating cash flow each year will be $1,822. Well, what we want to do now is solve for net present value. So note the net present value is calculated as of date 1, not date 0. Date 1, it's going to be calculated because that's the day the initial investment is made, at the end of year 1, beginning of year 2. So we will bring this all back to time 0. But for right now, we just want to know the net present value as of the beginning of year 2. So when we're calculating the cash flow present value, we want to make sure that we're using 4 as our periods. Okay, because the 1,600 here is the net present value at time 1. That's our initial investment. So we want our cash flows to be brought back to the end of time 1. So 4 periods, end of 2, 3, 4, and 5. When we do that, the net present value at the beginning of year 2, end of year 1 for this project would be positive $4,175.49. Okay, so that's how we do this calculation. Let's take a look at the net present value if the test is not successful. So the company comes up with these numbers. The initial investment is 1.6 million. Okay, again, under this scenario, the company feels the revenues would be 4,050, variable cost 1,735, fixed costs are still 1,800. So you see how those variable costs decrease as revenue projection is decreased. But fixed cost and depreciation remain constant. So our pre-tax profit would be 115, giving us tax of 24.15. So net profit would be 90.85, add back your depreciation. So cash flow under unsuccessful testing would be 490.85. Again, determine your net present value as of the end of time 1, beginning of 2, because that's when the 1.6 million will be invested to move forward with the project. So net present value under unsuccessful testing will be positive 91.461. we're just calculating net present value. What will be the result if we have a successful test? What will be the result if we have unsuccessful test? And again, that information is given. So now the firm has to make a decision. They have two decisions to make: to test or not to test. Okay, and to invest or not to invest. So if they test, okay, then their test will either lead to success or failure, unsuccessful. Just taking a look here. Okay. If they're successful, their investment, NPV, is 4.18 billion. That's what they determined. If they do not invest, the NPV is 0 because they wouldn't have done anything. Now, if you're sitting there going, well, what about all that stuff they paid in the beginning? That's a sunk cost. Okay, so that's ignored for these purposes. We're looking if we make a $1.6 billion investment into the future. Now, if they fail, so if the test fails and they still invest, they determine the NPV to be negative 44.07 million. Okay, so if they fail and they don't invest, NPV is 0. So first we have to take a look at, do we invest or not, based on the success and unsuccessful results. And then from there, determine if we should even test or not test. So if we test, these are our potential results. If we do not test, it's dead in the water. So we have to do a little bit more with our testing. I'm just going to. Okay, I took a time out there because I wasn't comfortable with the numbers I was seeing on here. And of course they were wrong. So, you know, first of all, this NPV is a negative 91.461, negative. Over here, this should be negative, not a negative 44, but a negative 91.0, whatever, 91 point whatever from that last test million. So we want to make sure we clear that up. So these were incorrect on the PowerPoint. Looking at it going, that just doesn't seem right. All right, so just to clear that up. Now, let's move back to the first stage where the decision boils down to the simple question, should we invest? Well, the expected payoff evaluated at date 1 is the probability of success times the payoff given plus the probability of failure times the payoff given through the failure. Now, what's important to remember here, going back to our decision tree, okay, success, okay, and in that same success, if we do not invest, our NPV is 0. So we're going to take expected payoff of 60%. That's expected payoff equals our probability of success times the net present value we calculated, plus 40% times 0. So the net present value, so that's our expected payoff overall if we're successful. So what is the net present value at date 0? So should we even complete the test? Given our success numbers, should we even invest that $1 billion up front to move forward with this project? So in that first decision, to come back here, should we invest or not? And that's our decision in here. And now we're going to look at, should we test or not? And that's what this calculation is showing us. So our initial investment would be 1 billion. Find the present value of the expected payoff at the end of year 1 if we are successful. Well, the expected payoff overall, doesn't matter if we're successful or not, because what we're doing is basing it on our probability of each. So we'll take that 2505.29, bring it back to present value. So we divide it by 1 plus the discount rate, and we get 227753, which is positive. That is higher than the amount we would have to spend to test to begin with. So overall, this project is positive. So we should test. So I know this is squirrely, this is kind of weird, and it's much more, we're going into higher analytics here. Okay, so one more time. We're going to, first of all, determine our net present value of the project at the end of the first year when we actually start the project. Compare it to if we're unsuccessful. Create a decision tree based on that information. Then, using the information related to a successful investment, determine our expected payoff. So take our probability of success, which would be given to us, times the payoff if there is success, which we determine in that net present value, plus the probability of failure times the payoff given failure, and that would be 0. Then take our expected payoff at the end of year 1 and bring it back to present value. So what's our expected payoff at the beginning of this? Well, it's more than the cost of testing to begin with. So we should test and move forward with this project. So that is how a decision tree decision is made. All right, so that's one method of using NPV and making decisions. Here's another, sensitivity analysis. We call this what if. It allows the calculation of a range of NPVs based on the probability of changes in NPV variables. So we usually use spreadsheets for this. And we would create models within our spreadsheets for these different variables changing. And when you use a spreadsheet and you change one variable, it updates your NPVs automatically. So let's see what else I want to discuss there. Okay. Let's take a look at this. We can see that our NPV is very sensitive to changes in revenues. Now, how can we do that? In the Stewart Pharmaceutical example, a 14% drop in revenue leads to approximately a 60% drop in net present value. So take a look. Our net present value. So if our revenue, our change in revenue decreases. So it goes from 6 to 7, or from 7 to 6. Let's do it that way. What we do is we say our second number is always our oldest number, and we always divide by the oldest number when we're trying to determine a change. So it'll be our new revenue, 6,000, minus old revenue divided by old revenue. So when revenue decreases $1,000, okay, it'll decrease overall 14.29%. When that happens, here's what happens to our NPV. NPV goes from 4175.49 down to 2939.24. Now that's already calculated for you based on that revenue being 6,000. So if you're like, where did that come from? It was calculated already. We're just showing you the end result and how we analyze it. Now, what does that lead to? The change in net present value, and that's wrong, the 60%, goes down 30%. So this should be when a 14% drop in revenue occurs, the net present value will decrease 30%, not 60. So for every 1% drop in revenue, we can expect NPV to decrease 2.96%. How do we know? Take NPV drop, so the decrease in NPV, divided by the decrease in revenue. There should be a minus sign in front of that. These PowerPoints aren't that great this chapter. So an overall decrease of 2.96. So for every 1% drop in revenue, we can then predict the impact on our net present value. It will decrease 3%. So in this scenario, we're holding everything else constant except for that revenue. And then we're recomputing that net present value to determine the overall impact when that one item changes revenue. Now, you can do a variation on sensitivity analysis, which is scenario analysis. And, you know, we have a couple practice problems and graded problems related to this. So scenarios now look at normal, best, and worst at a minimum here. So we're just looking at 3 scenarios. So here's our first one. Next year's here's the prediction, each have heavy cold season and sales exceed expectations, but labor costs skyrocket. So there'll be this crazy need for all of this common cold medicine. The next scenario, what if everything's normal and sales meet expectations? So we're doing scenario analysis now. What if the next year's each have lighter than normal cold season, so sales fail to meet expectations? So for each scenario we're looking at here, we want to predict our cash flows and then calculate the NPV for each one. Now in your book, so I'm not going to, the key here is this. When you're calculating these scenarios, you have your base, so that's your norm, you have your worst and your best. If the discounted projected cash flows, so your cash flows brought back to present value, are sufficient under all those scenarios to cover that initial investment, you can have a high level of confidence that your NPV is positive. Okay, so in each scenario, you can pretty much look at that because you can say, hey, all of my cash flows discounted under each scenario will lead to a positive NPV. So you may want to undertake that, even in your worst case scenario is positive. Let's go back into the book too. I wish we had a little bit more in the PowerPoint. So I want to take a look with you for sensitivity analysis, because it's a very conceptual discussion in your book, not a lot of meat and potato calculations. So if you look on page 264 to 265, they're looking at the jet engine. And I think this was from our very first, let's see if this was the jet engine. Yes. So it's carrying on from the example with the decision trees. And it's about the jet engines. And there's sales projections that are there. And what's important under sensitivity and scenario analysis, you really want to make sure you estimate revenues dependent on assumptions. So you just don't want to say, we're going to have $1 million in revenue. No, you got to make it, fine tune it and detail it back a little bit more than that. And this company said, okay, we're going to base it on market share, size of the market, and the price per engine. That's how we're going to project our revenue. So you can see here, the company, the size of the jet engine market in our base scenario is 10,000. We have 30% of it. So that means we'll sell 30,000 jet engines. If we charge $2 million each, that's $6 million in revenue. Okay. So if you turn the page to page 266, we could start setting up a little bit of a scenario analysis in table 9.2. And table 9.2 is showing you expected or best. 10,000 is the market share, or the total market. That's how many are sold per year of jet engines. 30% is what we will have of that market, and the price, the variable cost, and the fixed costs, and how much the initial investment is. The next page talks about the various costs associated with making the jet engine. And this is where they go into the discussion of variable and fixed costs. So the engine's variable cost is $1 million per jet engine. So every time you make one jet engine, it's $1 million cost. The fixed cost, no matter how many jet engines you make, is $1,940,000. $1,940,000,000. So now we're incorporating those costs into our analysis. So what the table 9.3 does below is it says, okay, let's keep something constant. Okay, let's keep everything constant except for one variable. And what they did was, in this analysis, and you could read underneath, it says, for example, a net present value of 2454 occurs when the pessimistic forecast is $5,000 is used for market size. However, the expected forecasts from table 9.2 are used for all other variables when 2454 is generated. Okay, so this is getting into a very advanced analysis and MPV calculation. Take a look back up on your table 9.2. Here's the projection for a pessimistic market. 5,000 jet engines are only going to be sold. There isn't a huge demand, and we're only going to have 20% of the market. And even under this, we're going to have to charge less because they're not in demand. The variable costs will increase to 1.2 million. So we're taking all of these costs into account under our pessimistic to calculate our net present value. And then the optimistic goes the other way. So here's your different scenarios. There's going to be 20,000 of these jet engines sold. We're going to have 50% of the market because there's such a demand. We're going to be able to charge 2.2 million. Our variable cost will decrease. Our fixed costs will as well. And we'll only have to make an investment of $1 million. So we want to calculate our NPV under each of these scenarios. okay, scenario analysis, and then do some comparison to see, okay, we'll have under the optimistic scenario, we'll have a 94.63 net present value. Under the expected, a 15.18, but under the pessimistic, we have a negative 24.54. Okay, so this table is helping us to look at all of those different NPVs and make some choices. So take a read through that. We're just showing you how we can use this to come up with different scenarios to determine if we should invest in a particular item. And looking at it beyond just what's its NPV, but well, what if we don't have the sales? What if we have a lot more than we expected? What kind of NPVs will result? All right. Now, break-even analysis. This is a common tool used for analyzing the relationship between sales volume and profitability. And you could think of break-even as how much do we have to sell in order to reach a certain profit or net present value. So there are three common break-even measures. Sales volume, at which net income is 0. That's our accounting break-even. So how many do we have to sell to have net income be 0? Cash break-even is the amount of sales we have to have operating cash at 0. And our financial break-even is the sales volume to have our net present value at 0. So we're going to focus most of this on our financial break-even. So let's go back to our example. In the Stewart Pharmaceutical example, there could be concern with break-even revenue, break-even sales volume, or break-even price. So we want to find any of these. Here's how we go through this process. We start with finding how much in sales do we have to have 0 operating cash flow, break-even cash flow. So remember, going back, you can take a look back at the items. We have, put it in your finance calculator, 4 cash flows. Discount rate is 10. The present value is 1,600 because that's how much we have to invest up front. So what we're going to calculate is the amount of cash flow, the PMT, that's required if we're going to produce this for 4 years, and we want the present value of those future cash flows to equal 1,600, the initial investment, because that's the point. Net present value would be 0. Your initial investment is 1,600, your future cash flows are 1,600. So I'm going to alpha solve, and you get 504,775. So if you're using your formula, you want to put in the information for the present value of an annuity, where the present value is 1,600, the N is 4, and the interest rate is 10%. And that will give you your PMT. So the amount of cash flow that this project must create is 504,775. Now you could work backwards to determine, okay, we know how much cash flow we need to break even, but how much in revenue is that? And we would have to use the information from the problem. So the first thing we would have to say is, okay, if we know we need 504,775 in cash flow, and 400 of that is from depreciation add back, and we want to determine net income, subtract it out. So operating cash flow, okay, of 504,775 minus depreciation will give us net income. Net income of 104,775 is 79% of earnings before interest and taxes. So if you take 104.75 divided by 79%, that's the amount of earnings before interest and taxes. Now, that 132.59, so you could find your tax would be 132.59 times 21%. So now we have earnings before interest and taxes. So now we have to include all the items that would be above that. So depreciation is subtracted to get to EBIT, fixed costs are, variable costs are. So we would need to know those numbers. Okay, so they're given here. So if we subtract the 3,000, the 1,800, and the 400 from our revenue, then that'll equal 132.59. So how much should our total revenue be? Well, variable cost of 3,000 plus 1,800 of fixed costs plus 400 of depreciation plus EBIT of 132.59. So 5,332.59. So you're working backwards. You got your cash flow. Now you have to determine, well, what's my break-even revenue I need to have, I will have when my cash flow is at break-even. Now that we have a break-even revenue, we can calculate break-even price. So the original plan was to generate revenues of $7 billion by selling the cold cure at $10 per dose and selling 700 million doses per year. We can reach break-even revenue with a price of only $7.62 per dose. The amount of revenue we need divided by the expected sell amount we're selling. Because the expected amount to sell times the price per dose will give us our revenue. So if we divide the revenue we need by the amount we're going to sell, 700 million, then the break-even price, we have to charge at least $7.62 per dose to have a zero profit, a zero net present value. Okay, that's minimum. So that helps us in determining sales price. Now there's another great example in your book. And I just want to run through it with you. And I know we're on Monte Carlo simulation, but in our book, but on our PowerPoint, but I'm on pages 268 through 269. Okay, so in this scenario, we have, what are we working on here? Amounts of revenues and costs of the project under different sales assumptions. Okay, so we have 0 sales, 1,000 sales, 3,000 sales, and 10,000 sales. And this was already, I don't know if it's something from a prior, I don't think so. It's just saying, okay, if we have 0 sales, our net profit will be 1,770,000. If we have 1,000 in sales, it'll be negative 980, and you could see the rest there. Now, where did those numbers come from? Well, this table would be created. You would say, okay, if we have 1,000 in unit sales, we will have 2,000 in revenue, 1,000 in variable costs. I think this is taking us back to our jet. One second here, our jet example. Yeah, because they were selling them for 2 million and then 1 million in variable costs. Yes. So this is going back to our jet illustration. Fixed costs were 1940. That's given in the problem. And these are on page 266. Depreciation is 300 because we will be depreciating the initial investment over Just give me a second to go back and see what we're doing here. Okay, so 1.5 million, and it'll be 5 years, right? So 1.5 million over 5 years, it'll give us 300 of depreciation each year. So after taking our revenues of 0 minus our variable cost of 0, fixed costs are 1940 and depreciation 300, that gives us negative. So that'll be a loss of, of 2240. So we'll have a tax savings of 21% of that, or $470. So what's the true net loss? 2240 minus the tax savings, 1770. Add back the depreciation. Cash flow will be negative 1470. And then you can calculate your net present value based on 4 cash flows of 1470 and compare it to your initial investment of 1.5. So that's how each of these are calculated. For instance, if annual sales are 10,000, revenues will be 10,000 times the selling price of 2, or 20,000. Variable costs will be 10,000 times the 1 million it costs to make them, or 10,000 here. Fixed costs are constant, so is depreciation. And then we would calculate based on that information for 10,000 sales. So we're looking for where NPV is 0. So it's somewhere between 1,000 and 3,000 in sales. And that's what this table is showing us here. So where exactly, and you can see this little graph, okay? The break-even point in sales is the point where revenues equal 2240. Okay. Fixed costs, I shouldn't say not revenues, where our contribution margin equals 2240. Now, what does that mean? Fixed costs you have to pay of 1940, and depreciation you have to subtract of 2240. So those costs are unavoidable. They're considered fixed. So your contribution margin, remember, that is sales minus variable costs, must be at least 2240. Well, 2240 contribution margin is determined by taking revenues minus variable costs. So what do your revenues need to be to get to a contribution margin of 2240? Well, revenues need to be twice the contribution margin, or $2 for every dollar of contribution margin. So 4480, and that's where the 4480 comes from. So that is the break even in revenue. Now, what's the break even in units? 2240. And that's what that graph is depicting. To get the dollar amount, let's take a look below. Again, sales price minus variable costs is what we call our contribution margin. Our contribution margin must equal our fixed cost plus depreciation at break even, to determine break even. So since our fixed costs plus depreciation are 2240, divide that by your contribution margin, or your accounting profit per unit, and that will give you the number of units that must be produced and sold to break even, 2240. Now let's go to the next page. So that's how we get that one more time of going over the accounting profit break-even point. But we are more interested in the NPV, right? So we're going to calculate the present value in this next, assuming a 15%. So when our unit sales, we did that already, right? So we're just recopying that on page 270. You could see somewhere between 1,000 and 3,000 units is where our NPV will be 0. So how do we get there? Well, the first thing we will do is determine our equivalent annual cost each year, or for the year, for this project. So we do that by taking the initial investment, dividing it by the 5 periods, 15%. 5 periods, 15%. So what we're saying here is how much basically payments need to be earned, just like we did before, in back here. Okay. How much do we need to have each year so that our net present value is 0? And that's basically the same as saying the equivalent annual cost. If we go into our finance calculator again, if n is 5 and we expect a 15%, our present value is the investment of $1,500,000. Solve for your payment, 447.5. So that's basically what your cash flow needs to be. That's your operating cash flow when everything is at break even. Since, and they note this here, since this is greater than the depreciation of 300 million, that's good. This must occur since the calculation of equivalent annual costs assumes the 1.5 million investment could have been invested at 15%. So what is our after-tax costs regardless of output? So that's what we calculate next. Our after-tax costs in order to break even. What must our costs remain at? And we find that by taking that annual cash flow, that PMT, that causes our net present value to be 0, plus those fixed costs net of depreciation. So fixed costs times 79%, we'll add that, so that's a cost. We're going to subtract, though, the tax savings from the depreciation. So how much does it really cost after tax for this project? 1,917.1. Well, now we want to determine our financial break-even point on that after-tax cost. Now, what's important here is, and we're determining what's the number of units we have to sell. Well, we don't take variable sales minus variable costs and just go, oh, our contribution margin, because we're not comparing before tax dollars here. If this was before tax in our numerator, then we would just use the $1. But since these are after tax costs, we have to make sure our contribution margin has taxes taken out of it. So that's why we take our contribution margin of $1 times 79%, the after tax cost. So, or you can take 1 million times 21%, subtract that, and you get the same answer. So when we do that, you can see the amount we have to sell for our financial break even is 2,426,000. Very close to our 2,240,000. So it's just another approach in determining, and a more specific approach in determining the amount we need to sell. Break even. The next area is called the Monte Carlo simulation. And this is just a further attempt to model real world uncertainty. You got to remember, when you're taking on a project, there are all kinds of risks involved. So its approach takes its name from the famous European casino. And I just want to go over what the simulation is about. It analyzes projects pretty much like you might analyze gambling strategies. Okay, so imagine a serious blackjack player, which I love blackjack, who wants to know if she should take the third card whenever her first two cards total 16. She could play thousands of hands for real money to find out. But this could be hazardous to her wealth. So what does she do? She could play thousands of practice hands. And that's what the Monte Carlo simulation does. It's in that same spirit. We're going to look at, if we do this in a simulation, what will be the outcome? So we look at it from a couple different scenarios, and we incorporate sensitivity analysis. And actually, it goes beyond it. It's highly probabilistic. Interactions between the variables are explicitly specified in this type of simulation, so we understand their relationship. If one changes, what happens? Theoretically provides a more complete analysis than maybe sensitivity and scenario analysis. And pharmaceutical industries have used this a lot, and it's starting to become more widespread in others. So yeah, that's all the PowerPoint tells us, right? But take a look at the example given in your book. They talk about backyard barbecues, just to give you a demonstration of it before we talk about real options. So Les Monte breaks up cash flows into three components. Let's find out who Les is here. Backyard Barbecues is a manufacturer of charcoal and gas grills. It has a blueprint for a new grill that cooks with compressed hydrogen. The CFO is being dissatisfied with simpler capital budgeting techniques. So maybe the simulation and the sensitivity analysis just isn't doing it for the CEO. So they hire a consultant to use the Monte Carlo approach to determine if they should take on this project. So Les decides to break up cash flow into annual revenue, annual cost, and initial investment. So first, the very basic model is they take a look and they say, okay, the number of grills sold by the entire industry, kind of what we were looking at before, times the market share that Backyard Barbecues usually has, times the price per hydrogen grill. Then we look at the cost, the variable, and the marketing. So we got to define all this. And then what's the initial investment cost? Then we go into the hard part. So now we have to start specifying a distribution for each variable in the model. And this goes into a lot of detail analysis. So for instance, they start with the revenue, has three components, remember. So the consultant's first model, overall market size. So what's the number of grills sold by the entire industry? And he uses a publication to get his information. He said that they reported 10 million grills of all types that were sold last year, and they forecast them to be 10.5 million next year. So he creates the distribution below and the probabilities based on information about the industry that these will be hit. Les realizes that estimating the market share of hydrogen is more difficult. But after a great deal of analysis, he determines the distribution of next year's market should be, and that's what he does. So the probability and then the market share of BBI's hydrogen grill next year. So you can see we're getting into very complex analysis. He then goes on to look at grill prices and how they'll be determined. So here's what he says. Next year's grill price will be $190 plus $1 times the industry unit sales in millions plus or minus $3. So now we're getting into more forecasting. And then he goes on to say, okay, what's the probability that these two amounts will occur? And you can see it said 50% chance it could be plus $3, 50% chance it could be minus $3. Puts this information into the computer and starts doing analysis based on these probabilities and keeps repeating these procedures and calculating the net present values until they find the scenario or determine if they should take on this project or not. So it's a very high level, complex analysis, but it is used. So we just want to make you aware of it. You're not going to be doing any. We just want to make you aware of what the Monte Carlo simulation is and how detailed you have to get with your different variables. Last section, real options. So one of the fundamental insights of modern finance theory is that we have options out there and they have value. Corporations make decisions in dynamic environments. So a choice of options should be considered in our project valuation. We have three real options. We have the option to expand. So this has value if the demand turns out higher than expected than our prediction. The option to abandon. This turns out if it's lower than expected. And then we have a timing option, which has value if the underlying variables are changing with a trend. So we can calculate the market value of a project. So what's it worth? As the sum of the net present value of the project without options and the value of managerial options implicit in the project. For instance, so there's our formula. A good example would be comparing the desirability of a specialized machine versus a more versatile machine. If they both cost about the same and last about the same amount of time, the more versatile machine is more valuable because it comes with options. So what we're saying here is that this option has to have a value put on it because it's within a project or an item, like for instance, the versatile machine. It'll change with different scenarios. So let's take a look. We'll take a look at this one. Suppose we are drilling an oil well. The drilling rig costs $300 today, and in 1 year, the well is either a success or a failure. The outcomes are equally likely. The discount rate is 10%. The present value of the successful payoff at time 1 is $575. The present value of the unsuccessful payoff at time 1 is 0. So going back to the beginning of the chapter, our traditional NPV would indicate rejection of the project. So expected payoff is our probable success of that 575 net present value, that payoff plus 50% 0, probable failure. So our expected payoff is 287.50, but that's at the end of year 1. So now we have to bring it back to time 0 when we make that initial investment of 300. So divide the 287.50 by the 1 plus the discount rate. So under this scenario, our net present value would be negative, which signals rejection. However, That type of analysis overlooks the option to abandon. Okay, so take a look. If we don't drill, our NPV is 0. If we do drill, we'll have a negative 300. If we have success, we'll have present value of 575. If we have failure, we'll sit on a rig and stare at an empty hole. If we have failure, we could sell the rig and salvage $250. So now, when we start looking at this option, watch how our net present value and our expected payoff changes. So if we succeed, we have a 50% chance of that, 50% of 575. But if we fail, the payoff will be $250 because we'll get that as salvage value. So we have a 50% chance of that happening. So the expected payoff, according to our probabilities, is $412.50. Now we have a positive net present value. So you have to take into account these real options that exist when doing this analysis. And you can see how it affects if we abandon a project or not. So we recall that we can calculate the market value of a project then as the sum of the net present value of the project without the option. So we have that negative 38 and the value of the managerial option implicit in the project. So that's 75. So our value of our option here is 113.64. Remember that 75 is the net present value plus that option. So we just want to determine, well, how much was that option worth? 113.64 in terms of present value. That contributes to the market price. Here's an example of timing options. So consider the above project, which can be undertaken in any of the next 4 years. The discount rate is 10%. The present value of the benefits at the time the project is launched remains constant at $25,000. But since costs are declining, the net present value at the time of the launch steadily rises. So remember, costs would cause our net present value, they go down to increase. So the best time to launch this project is in year 2, because that's when the highest NPV would occur. So we're just setting up here for timing options. So now we're like, oh, we could do this project. When should we do it? Well, this is what you will do. Determine how much the cost would be each year, the present value of that project each year, then determine the net present value at time t and time 0. So time t would be the end of year 1, end of year 2, end of year 3, end of year 4. And then we would determine the net present value of each net present value at the end of each year. So of course, net present value at time 0 would be 5,000, the same as the net present value. But at the end of year 1, it would be 7,000 divided by 1.10. At the end of year 2, it would be, as you can see there, 7,900 divided by 1.10, 1 plus the discount rate to the second power. At the end of year 3, and at the end of year 4, at the end of year 3, your numerator or denominator would be 1.10 to the third power, and at the end of year 4, 1.10 to the fourth power. And that's how you would determine that net present value. And based on the highest net present value, that will tell you when to undertake this project. Time 2. Okay, so that was a lot of stuff, right? These are some blank slides. So not heavy on super detailed calculations like we have in other chapters, but some. We are using net present value still very heavily in creating our decision trees and making decisions based on that, completing sensitivity and scenario analysis, as well as break-even analysis. And that's probably where we had the most calculation for this chapter, determining break-even profit, break-even cash flow, break-even NPV. We looked at the Monte Carlo simulation just to get an idea of it. I know that's really high level analysis, but if you have any questions, let me know. And then how we incorporate these items using net present value into determining, should we expand, should we abandon, when should we start something, and keeping in mind that we have options incorporated within the project that may not be included in some of our calculations. So we want to make sure that when we are determining, for instance, we saw with the abandoning a project, we really take into account all the items that need to be involved in determining that. Okay, so post any questions you may have to the discussion board.